Welcome to the Deep Dive, where we cut through the noise and get straight to the essential insights. Today, we're diving deep into a company almost everyone knows, Procter Gamble, or PG. But maybe, not everyone fully understands it from an investment perspective. We've really dug through a mountain of analyses, market reports, financial data, all carefully put together to give you a sharp, insightful look at PG's current standing and its future potential.
Yeah, and what's truly fascinating about this deep dive is, well, we're not just dissecting a corporate giant. We're exploring this intricate web of factors that influence a consumer powerhouse like PG, everything from global economic shifts right down to the products that are probably in your home right now. Our mission today is really to equip you, the discerning investor, with clarity and hopefully some actionable knowledge.
Right. And I think the big question we're really digging into today is, can a company like P&G, so deeply ingrained in our daily lives, with almost, 2 centuries of history, can it still find significant growth? Can it outmaneuver this fast-changing consumer landscape to deliver those consistent investor returns you're looking for? Let's peel back the layers.
Okay.
So Procter & Gamble, the name is almost synonymous with everyday products, right? In your own home. It's got this incredible history. Started as a small soup and candle maker way back in 1837 and grew into the global powerhouse it is today. What elements of that long history, maybe its foundation in essential goods, are still, core to its strengths for investors now?
That's a great point. What's really insightful about PG's deep roots in essential consumer goods is how it kind of acts as a silent inflation hedge. During periods of rising costs, P&G often shows this unique ability to pass on modest price increases without losing too much volume.
Yeah.
And that's really a testament to the daily necessity, the profound brand loyalty their products have built. It makes their business model, relatively less sensitive to economic downturns.
Right.
Offers a certain level of stability to your portfolio.
And that brand loyalty, it comes from an undeniably powerful brand portfolio. Global recognition. We're talking household names: Tide, Pampers, Gillette, Crest, Downy, Bounty, Charmin, Olay, Head & Shoulders. The list goes on. These are multi-billion-dollar brands. How does that massive scale translate into a competitive advantage?
Well, their economies of scale are truly remarkable. Just the vast scale of production, their extensive distribution systems, it allows them to achieve cost efficiencies that, frankly, smaller players just can't match. And it's not just manufacturing. It extends to their formidable negotiating power with retailers globally.
Oh, right.
This scale, combined with continuous innovation and, let's be honest, very strong marketing, helps them adapt to evolving consumer trends and maintain that crucial market share against a whole range of competitors.
Okay, so we've touched on the foundation of P&G's strength, but for you, the investor, the real story is often in the numbers. When we crunch P&G's financials, what are the absolute must-watch indicators?
Right. So beyond the usual suspects, net sales, net income, gross and operating margins, cash flow, earnings per share, all important. Of course, the one metric that really stands out for P&G is organic sales growth.
Okay, why is that one so crucial?
Well, it raises an important question, right? Why organic growth? It's really the purest measure of PG's core competitive strength. It completely strips out the impacts from, say, acquisitions, divestitures, or currency fluctuations. You really want to see strong, consistent organic growth. That tells you the underlying business is truly healthy, the demand is actually growing. Their powerful operating cash flow is also essential. It fuels reinvestment back into the business. It supports that highly valued dividend and enables share buybacks, which directly return value to shareholders. But always keep an eye on raw material and transportation costs. Those can really impact their margins.
And P&G's revenue, it's split into 5 major segments, which gives them that diversified base. You've got Beauty Think, Head & Shoulders, Pantene, Olay, SK2, Groom & Gillette, Venus Razors, Shaving Stuff, Healthcare Crest, Oral-B, Vicks, Fabric and Home Care Tide, Ariel, Downy, Febreze, Swiffer, and finally, Baby, Feminine and Family Care, Pampers, Always, Tampax, Charmin, Bounty, quite the list.
It is. And across these segments, you see some clear trends. First, exceptionally high brand loyalty stemming from decades of consumer trust. Second, a strategic push towards premiumization.
Premiumization, like making things fancier.
Sort of, yeah. Think about how Gillette constantly innovates with new blade technologies, right? Or Olay introducing advanced skincare lines. These aren't just new products. They're designed to capture higher margins by offering, superior solutions, or at least perceived superior solutions. And critically, there's also a significant expansion into e-commerce channels to meet online shopping trends. Plus, that continued push for growth in emerging markets. That's a big long-term growth driver for them.
Okay. So when you're analyzing their recent earnings reports, what are the key takeaways for you as an investor? What should you look for?
First off, check if their total revenue, EPS, and especially that organic sales growth, met or beat what the market was expecting. That consensus figure, that's usually the first thing the stock reacts to. Also, pay close attention to the organic sales growth across each business segment, not just the total, and the overall average, of course. It's also really important to distinguish why revenue is growing. Is it primarily driven by price increases, or is it an actual increase in sales volume?
Ah, volume growth is better, right? More people buying stuff.
Generally, yes. Volume growth indicates real demand expansion, which is usually a more positive sign long term, and evaluate if they're effectively defending their margin rates. Especially with ongoing cost pressures from raw materials or logistics, can they pass those costs on without losing too many customers to, cheaper alternatives?
Right. And don't forget their guidance, what the company expects for future quarters and the full fiscal year. That's a critical indicator for future stock performance. Tells you management's view.
Exactly. And when you assess PG from an investment perspective, you'll look at key metrics like the price to earnings or PER ratio. Now, for PG being a defensive stock, its PER often trades at a slight premium compared to the broader market. That reflects its perceived safety and consistent earnings, even if its growth isn't, explosive.
Makes sense.
Similarly, you'd look at price to sales, PSR, price to book PBR, and enterprise value to EBITDA. PG is typically classified as a defensive stock, holds up relatively well in economic downturns, and critically, it's a dividend growth stock. That's a huge part of its appeal for many investors.
Yeah, let's talk about that dividend. For many income-focused investors, P&G's dividend history is often the primary draw. Why does their track record stand out so significantly? It really is legendary at Dividend King, over 69 years of increases.
It's more than legendary. It's a powerful statement about the business. This long history of dividend increases, consistently, even through severe economic downturns, think the 2008 financial crisis, the recent pandemic, it speaks volumes about their stable cash flow and their strong commitment to shareholder returns. So for you, this consistent track record, along with their current dividend yield, the growth rate of that dividend, and the payout ratio, which tells you how sustainable it is, all that is crucial. It makes them a top choice for income-focused investors who really value reliability.
But does such a strong dividend commitment ever come at the cost of, say, vital R&D or maybe more aggressive market expansion? How do they balance that?
That's a fantastic question, and it's absolutely something P&G has to constantly balance. It really speaks to their financial discipline. They've managed it for so long.
Okay, so beyond these core financials, what broader factors should you keep an eye on that could influence P&G's stock price?
Well, earnings releases are paramount, as we've discussed, particularly organic sales growth, margin performance, EPS, and that future guidance. Those are the direct indicators of how the business is doing right now. Beyond that, cost pressures. We mentioned raw materials, pulp for paper products, petrochemicals for plastics, palm oil for lots of things. Changes there directly impact manufacturing costs. Then there's the volatility in transportation and logistics costs. Think oil prices, supply chain bottlenecks.
Yeah.
Those can squeeze profits significantly too.
Yeah, and while P&G's massive scale and brand power definitely help them manage these costs, gives them negotiating leverage, ability to pass some increases on, they remain a key focus for investors. And with such a huge global footprint, currency fluctuations must also play a big role, right?
Absolutely. A strong U.S. dollar, for instance, can reduce the value of their very substantial international sales and profits when they're converted back into dollars for reporting. It's purely an exchange rate effect, but it hits the bottom line. We also need to consider consumer spending trends and inflation. P&G's essential products can act as a bit of an inflation hedge because they do have some ability to pass on price increases. People still need toothpaste and detergent. However, if inflation gets too high, or if consumer purchasing power really weakens significantly, then you might see consumers shift. They might move from P&G's premium brands to lower-priced store brands or private label options. That would definitely impact sales volume.
Yeah, it really brings to mind those moments in the grocery aisle, doesn't it?
Yeah.
Looking at the familiar P&G brand next to a much cheaper store brand. How often does P&G see that downtrading actually happening, and what's their strategy when it does?
That's a perfect example, and P&G is acutely aware of that downtrading risk, especially in tough economic times. Their strategy isn't just about matching price, because they often can't. It's about continuously reinforcing the value of their brand through innovation, performance, and marketing. The idea is that even if you try private label, you'll quickly return to the perceived superior performance or experience of a Tide or a Pampers. And this leads us right into the competitive landscape, which is, well, fierce. P&G faces global players like Unilever, Colgate-Palmolive, Kimberly-Clark, L'Oreal. Their ability to innovate, launch new products, especially in trendy areas like eco-friendly or premium lines, is crucial. And their whole strategy for e-commerce growth and digital marketing, that directly impacts their reach, which is increasingly important today.
Right. And finally, there's ESG, environmental, social, and governance issues. Plus, there's shareholder return policies, like those dividend increases and share buybacks we talked about. Those can significantly impact the company's image and how investors feel about it. And just overall market sentiment itself may be favoring defensive stocks during uncertain times, or seeing PG specifically as an inflation hedge that can drive demand from big institutional investors.
Okay, so we've clearly established P&G's formidable advantages: strong brands, scale, dividend history. But like any investment, it's not without hurdles. What are the most significant risks and competitive pressures you, as investors, should really be aware of when considering P&G?
Let's get specific on the potential risks. Beyond the cost and currency volatility we touched on, a major one is that weak consumer purchasing power and downtrading risk. High inflation, a severe recession that could really push consumers to switch from P&G's often premium brands to more affordable private label products or just cheaper competitor offerings. That directly hits P&G's sales volume and their pricing power. And on the competitive front, it's not just the big global players like Unilever, is it? It feels like pressure comes from all angles now. What are maybe the top 2 or 3 competitive threats that keep PG's leadership focused?
Absolutely, it's multifaceted. First, the sheer scale and sometimes agility of global giants like Unilever, especially in emerging markets where Unilever often has really strong local distribution. They're direct rivals across many categories. Second, it's the rise of those nimble, online-first or niche brands. Smaller players targeting specific consumer needs, vegan, organic subscription boxes. They leverage online channels really effectively and can sometimes challenge P&G's dominance in certain niches.
Yeah, I see those popping up all the time.
Exactly. And critically, don't underestimate retailer private brands, PB. Big retailers like Walmart, Kroger, Target, they're seriously strengthening their own private labels. They offer lower-priced alternatives right there on the shelf, putting significant pressure on established brands like P&G's.
So staying ahead must mean constant innovation, which sounds expensive.
Exactly. Increased innovation and marketing costs are a continuous drag isn't quite the right word, but a continuous need for spending. It impacts earnings. Staying ahead requires constant investment in R&D for new products and really aggressive marketing to maintain brand visibility and market share against all those competitors. And finally, ESG risks. Stricter environmental regulations, think plastic use, carbon emissions, plus evolving consumer preferences for sustainable products. That might force costly changes in P&G's production and packaging. And any ethical concerns popping up in their global supply chain can seriously damage brand reputation and, investor confidence.
That's a pretty comprehensive list of challenges. But okay, despite these formidable challenges, P&G clearly maintains strong competitive advantages. Remind us what those key ones are.
Right. Despite the risks, they have major strengths. First, that overwhelming brand portfolio. Multi-billion-dollar brands like Tide, Pampers, Gillette, that grants them exceptional consumer loyalty and, crucially, pricing power. Allows them to sometimes raise prices without losing too much market share. Second, their vast global market dominance. That extensive distribution network across 180-plus countries provides a stable, diversified revenue base. Furthermore, their economies of scale allow for superior cost efficiency in manufacturing, procurement, logistics. And their robust R&D and marketing capabilities ensure continuous product innovation and that strong brand presence, helping defend their market position against, all types of competitors.
Okay. Now, for those of you who also look at stock charts, let's quickly touch upon some technical analysis concepts. But keep in mind, this is based on past data. You need real-time charts for current decisions.
Sure. For a blue-chip stock like P&G, technical indicators like support and resistance levels often act as pretty strong confirmations of long-term investor sentiment. Unlike maybe more volatile growth stocks, P&G's price movements tend to be a bit more predictable around these levels. You often see consistent buying interest at support levels during broader market corrections, which kind of underscores its safe haven appeal.
Right. We also look at moving averages. Short-term ones, like the 5-day or 20-day, give you a sense of immediate trends. And long-term ones, like the 50-day or 200-day, show the broader trend and often act as dynamic support or resistance levels themselves. You sometimes hear about a golden cross, short-term average crossing above long-term, seen as a buy signal, or a death cross, the opposite, seen as a sell signal.
Yeah, and other indicators like volume are important for validating price moves. If a big price move happens on high volume, it's generally considered more reliable, more conviction behind it. RSI, Relative Strength Index, can tell us if the stock might be overbought or oversold, potentially signaling a reversal is due. And MACD, Moving Average Convergence Divergence, helps identify trend strength and potential reversals too. However, I'd stress, for long-term investors in a company like P&G, the fundamental analysis, the business itself, the earnings, the dividends, often carries more weight than short-term technical signals. Macroeconomic news or earnings results can easily override technical patterns.
Good point. Finally, let's talk about P&G's internal strengths. What makes them truly resilient and capable of long-term growth from within, almost regardless of what the external market is doing?
Yeah, their internal capabilities are absolutely critical for that sustained success. First, you have to look at management leadership and vision. Their ability to strategically manage that huge brand portfolio, decide where to invest in innovation, including using things like AI for marketing and supply chain optimization now, and effectively control costs amidst all those pressures we talked about.
Yeah.
That's key. Second, research and development R&D capabilities. A strong R&D pipeline is essential for continuous product innovation, meeting those ever-evolving consumer demands for new features, better performance, and increasingly, sustainability. Third, production and supply chain management. Efficient global production, a flexible supply chain. That's key to minimizing costs and ensuring products are actually on the shelves consistently, despite external disruptions like, geopolitical events or natural disasters. Fourth, brand management and marketing expertise. Maintaining that brand equity built over decades and effectively engaging consumers across all platforms, TV, digital, social media, using data-driven marketing. That's vital for staying top of mind. And finally, underlying it all, financial health and capital allocation. P&G's strong operating cash flow is the foundation. It pays for reinvestment, those dividends, the share buybacks. Efficient capital allocation and maintaining a relatively low debt ratio ensure financial resilience and are crucial for maximizing shareholder value over the long haul.
Okay, so after this comprehensive deep dive, wrapping it all up, what does this all mean for your investment portfolio?
Well, Procter Gamble clearly stands as a premier consumer goods company. It generates stable revenue and profits thanks to that powerful global brand portfolio and its defensive business model. Its dividend king status, over 69 consecutive years of dividend increases, really underscores its robust cash generation and that strong commitment to shareholder returns. So this makes it an incredibly attractive prospect for you, the long-term investor, especially if you're seeking portfolio stability and consistent dividend income, particularly in uncertain economic climates where, reliability is highly valued.
However, you absolutely must keep a close eye on those ongoing challenges. Fluctuating raw material and transportation costs. Currency volatility is a big one for them. The potential for consumers to downtrade to cheaper brands if inflation stays high or a recession hits. And that intense competition from both the global giants and those smaller emerging niche brands. P&G's ability to efficiently manage cost pressures, drive organic sales growth, and continually strengthen its e-commerce game will be absolutely paramount for its continued success.
Ultimately, P&G's robust brand power, its defensive business model, and that excellent dividend growth history significantly enhance its investment appeal. If you prioritize stability and consistent returns, especially when economic uncertainty is looming, P&G, maybe alongside other defensive giants, remains a very suitable choice for your portfolio. But remember, maintaining innovation for sustained growth and achieving continuous cost efficiency, those are persistent challenges the company has to constantly navigate.
So what stands out to you after this deep dive? As you consider P&G, maybe think about how consumer habits might continue to evolve over the next decade. Will their powerful brands continue to dominate as they have? Or will new disruptive forces emerge that really challenge their long-standing position? That's a deep dive for you to continue. If this deep dive was helpful for you in making informed investment decisions, please subscribe.